the psychology behind Buffett's calm during market chaos. So what exactly happens in Warren Buffett's brain when the market plunges 30% and everyone else is losing their minds? While most investors are panic selling their portfolios and checking stock prices every 5 minutes, Buffett sits back with an almost eerie calm, sometimes even smiling. What's his secret psychological advantage? Let's be real. During market crashes, most of us get hit with a tsunami of emotions. Your heart races, palms get sweaty, and suddenly that retirement account you've been building for years feels like it's evaporating before your eyes. This is your brain's ancient fight or flight response kicking into high gear. Your amygdala hijacks your rational thinking, and boom, you're panic selling at the worst possible moment. But Buffett? His brain operates completely differently during these crisis moments. While everyone else sees disaster, he sees the investing equivalent of a Black Friday sale. He experiences those same biological fear responses as the rest of us. He's just trained himself to override them with a psychological framework that completely flips the script on market downturns. That famous Buffett quote about being fearful when others are greedy and greedy when others are fearful is his actual operating system. The mental framework he uses to make decisions when markets go haywire. And his secret psychological advantage might surprise you. It's his temperament. Buffett himself has said that temperament is more important than IQ when it comes to investing. The Oracle of Omaha believes that managing your emotions is more valuable than being a mathematical genius. He spent decades training himself to resist those primal stress responses that cloud judgment when stocks are tanking. While other investors are driven by panic, Buffett maintains what psychologists call emotional equilibrium, the ability to stay balanced when everything around you is chaotic. One of his most powerful mental techniques? Buffett fundamentally reframes what a stock actually is. While most of us see stocks as ticker symbols, fluctuating prices, and green or red colors on a screen, Buffett sees partial ownership in actual businesses with real value. This completely changes his emotional reaction to price drops. When you see Apple down 25%, your brain registers it as a loss. When Buffett sees the same thing, he's thinking, Apple, the company that makes products used by billions, is now available at a 25% discount. That reframing creates a totally different emotional response. It's exactly like walking into your favorite store and seeing everything marked down 30 to 50%. Most people feel excitement, not panic, when they see sales. That's precisely what happens in Buffett's brain during market crashes. He actually gets a dopamine hit, the brain's reward chemical, when he sees quality businesses available at discount prices. There's another key element to Buffett's psychological advantage: expectation management. Most investors are emotionally devastated by market crashes because they're surprised by them. Buffett, however, expects and prepares for them. He knows market history shows that significant downturns happen regularly. By accepting this as normal rather than exceptional, he removes the shock factor that triggers panic in other investors. Picture going on a boat ride. If you're surprised by a huge wave, you'll probably freak out. But if you're expecting waves and have prepared for them, you'll stay much calmer when they hit. That's what Buffett does with market volatility. He's not surprised by 30% drops because he knows they'll happen eventually. This expectation management creates a psychological buffer that protects him from emotional decision-making. Buffett also employs what psychologists call cognitive reappraisal, the ability to reinterpret an emotional situation in a way that changes your response to it. When markets crash, most investors think, "I'm losing money. This is terrible." Buffett reappraises the same situation as, "Businesses I understand are now on sale. This is an opportunity." Same external circumstances, completely different internal response. This explains why Buffett can maintain his legendary patience during turbulent markets. While others are desperate to take action to stop the pain of losses, Buffett has trained himself to separate the emotional experience from the decision-making process. He follows a disciplined, rational approach regardless of what the market is doing. Something that sounds simple, but is incredibly difficult for most humans to actually do. Buffett limits his exposure to market noise that might trigger emotional responses. He famously avoids watching the stock market ticker throughout the day and doesn't have a computer on his desk. By limiting the inputs that could trigger fear responses, he protects his rational decision-making ability. Studies have shown that investors who check their portfolios daily during crashes experience significantly more stress than those who check weekly or monthly, even though the actual financial outcome is identical. Buffett instinctively understands this and protects his mental state accordingly. Another key aspect of Buffett's psychological advantage is his long-term perspective. While most investors worry about next week or next month, Buffett thinks in decades. This time horizon shift fundamentally changes how your brain processes market volatility. If you're focused on a 20-year horizon, a one-year market crash becomes a tiny blip rather than a catastrophe. Perhaps most importantly, Buffett has built a psychological feedback loop from his past experiences. Each time he successfully navigated a market downturn and come out ahead by buying quality companies at discount prices, it reinforces his confidence in the approach. This creates a virtuous cycle where each crisis he weathers makes him even calmer during the next one. He has decades of personal experience proving his approach works.